Good morning. This is Ken Long from Tortoise Capital Management with the review of the weekly strategy report for July 9th, 2011. We have a market that's in bullish normal conditions, high neutral for annual weekly RSI 14, oversold on a 10-day basis with the 10-day NDX reading at 86 out of 100. Percent stretch above the 200-day moving average is in the yellow at 6.32%, which is bullish. The slope of the 50-day moving average remains slightly positive at 0.02%, but that's rated as red and slightly bearish because of the how much better it's been in the last 180 days. ADX creep back above 21 on increased buying pressure this week. ATR percentage pulled back a little bit to 1.21%. It's still at the high end of normal. No change in the blended monthly rebalancing holdings for the 26 of the 13 ETF portfolio, with next reevaluation on or about 1 August. No changes in ETF2 other than to adjust stops upward. Theoretical exposure is at 90%. The model portfolio is at 100%. Looking at the market health check, we have, again, the vertical blue lines are 10, 20, and 30-day look-back periods. Solid purple line is the previous swing high at 137, which is our target. Dotted purple line, previous swing high, which is now shaping up to be supported about 133 3/4. The first solid red line is the 5% pullback from the swing high, which represents the noise area for price. Below the red line and to the bottom of the red box would be the range for up to a 10% pullback from the swing high, which would be considered a correction in a bull market. Central black line is the slope of the 30-day regression line. Just the slope, just the regression line itself, excuse me. The slope is indicated down here. You can see it just went positive with the price action of the last 10 days. We have price north of the 10-day moving average, which is crossed back above the 50. So that's favorable. So price better than the 10, better than the 50, better than the 200, which is starting to appear now as the shaded area on the chart. The channel of the regression line is pretty wide right now based off the maximum excursion from the regression line itself caused by Thursday's excursion. We have Williams percent R10 has been overbought here for about 5-6 days. Continues to be that way. The jaws of PPO, the percent price oscillator, still open, still wide, but starting to close a little bit. You can see with the sell-off here on Friday, that little pullback has caused just the slightest of weakening in those technical indicators. Taking a look at the top 10 regions of the world market model for ETF2, all of them except Europe 350 are positive for the moving average filter. That puts us at 90% invested, 10% cash. SPY is better than EFA 62 to 51. Inside the U.S., it goes mid caps, small caps, large caps, tech. Strongest sector is mid caps, and then the small caps for the U.S. And then the two weakest are ILF and EEM. In the globals. World market model strength, again, small and mids on the growth side. Pullbacks in oil and in the commodities. The commodities are still slightly above average, but not as green as they were last week. The defensive sectors, staples, utilities, healthcare, continuing to do well. Swiss franc holding steady. Switzerland and Germany remain strong inside Europe. Weakness, generally speaking, in Asia and the emerging markets. U.S. has the strength right now. The 100 by 200 crossover system reflects the same information using slightly different indicators. Again, it's the U.S. sectors are generally positive. The globals are weakening. Looking at the top 30 from the ETF2 database, remains healthcare, pharmaceuticals, biotech, mid-cap growth, retail, more healthcare, real estate, food and beverage, consumer discretionary, utilities, small-cap growth, Swiss franc. Again, you can see all the usual suspects. The order changed slightly, still favoring healthcare right now, but still the same leaders from last week, all the defensive sectors. And the for reference, the liquidity numbers, and you can see silver has continued to decline in volatility, still very tradable at 2.46%. And gold and silver remain in positions 5 and 6 with a comfortable margin over energy. And that's the weekly strategy report. I'm going to move right into the daily. I'm not going to repeat the top bar. Looking at the gap stat, 14 times in the last 30 days, the market has gapped down. It's continued to drop for an average of 0.91% loss. 7 out of those 14 times, the other 7 times, it's reversed to close higher with an average score of 50.50%. So right now, the size of the move is still favoring the gap down and failures. On the gap up, 16 times in the last 30 days, 3 out of 4 times the gaps up have been rewarded with a follow-through of 0.53%, so that's really the way to play that one. Range stat in SPY is still about 1.5%. See time series of 10-day NDX. Market remains comfortably overbought here. No signals and overreaction and channeling. Pivot point above 134 now. You can see the pullback in volatility over the last week to just slightly north of average. And the plus DI has now eclipsed minus DI for strength of trend. 10-day max pain, the losing positions have been, Bank of America, Pfizer, JP Morgan, General Electric, Hewlett Packard, VIX, natural gas, oil, Australia, and gold. 10-day min pain, these have been the winners: Merck, ExxonMobil, Microsoft, Coca-Cola, Procter & Gamble. Right now, the only pattern we have is the channeling pattern inside Pfizer. And you can see it there. And then the top 5 max pain range compression candidates. Microsoft really standing out with all the green here. Merck has been a winner. I would look for additional strength in Disney. American Express, not too bad, although sell-off on Friday. Among the ETFs, no patterns, and then you can see again the max pain range compression candidates: VIX, natural gas, treasuries, agriculture, and utilities. Silver remains pretty strong. It seems to have recovered itself nicely from the sell-off. Gold did well. Fraud candidates, utilities still number 1. Reliable intraday trading with a standard deviation of only 0.07. ExxonMobil, AT&T, Chevron, Alcoa, Merck, Cisco, and General Electric rounding out the top 10 for quality of fraudishness, if you will. 30-day regression line is tilted positive. You can see the jaws are continuing to expand here. That's favorable. And it's made a more than a 2 standard deviation move and is now back above average of the last 180 days and above the dotted line, meaning it's positive, tilted positively. The stretch above the 200 has made a nice bounce and holding right here. Still has room to go. Range stat percentages for the usual suspects. And the X period holding stats. It looks on a 5-day basis, we're back down underneath 1 standard deviation, so the market has held well, digested without selling off. That's very favorable. 30-day quality report for the Dow. I'm looking at the divergence column now. Bank of America, Hewlett Packard, Microsoft, and Verizon are of interest. You see Procter & Gamble's weakness has gone 2 months ago. It was in the green and is now back down in the red. We're looking for a reversal of that kind of stuff. I like Microsoft where it went from yellow to green as an example of current shift in strength. Among the ETFs, Latin America, Brazil, finance, and emerging markets, and even Japan in the green. and starting to see some weakening of the defensive sectors here, utilities, healthcare, and consumer staples. That could be a recognition of cycling within the U.S. sectors, as starting to see the risk on trade to start to develop. Gap statistics for the usual suspects of the indexes, and SPY is consolidated back inside its safe zone channel. Daily pivots calculated for reference. You can see the risk on trade is starting to work inside the U.S. with technology, mid caps, and small caps at the expense of the Dow. We have the commodity complex here consolidating and starting to roll over, and then the globals definitely underperforming the U.S. lately. Although the stability of the last week, who knows? Right now it's risk on and with the U.S. indexes. No signals from the safe zone, and just the top 15, the top percentage performers for your reference. Again, extreme conditions produce extreme results. And volatility summary, you can see because of all the yellow, you see volatility actually starting to come out of the market. And that's review of the daily trading plan. Shift right over to charts of interest. Alcoa, I like. PPO is positive, holding steady at the 50, poised for another nice run. Boeing has done a nice job also, holding at the 50. Caterpillar, clear leader now. PPO is even more advanced. It held well above its 50 and its 20. Cisco has just been a poor to below average performer in tech. Hasn't even got back to the 50 yet. Chevron, on the other hand, blasted through it comfortably. Agriculture and energies both hovering around their 50 as commodities get sorted out. EFA lagging behind the U.S. and EPP, Asia less Japan, marking time. Brazil, disappointing the last 2 days along with ILF. Brazil has actually been weaker than ILF. Hewlett-Packard unable to even break through its 50. A disappointment. Intel, strength in technology here, very positive. PPO and through the 50. Russell small caps showing why they are they are the strength leaders. They and MDY, so that's the number 2 strength among the indexes. Johnson & Johnson made a nice recovery, has held above 67.5. That looks favorable. Kraft in excellent shape. Coca-Cola, McDonald's just terrific. McDonald's still remains the strongest chart in the deck. MDY showing why it's the strongest of the indexes. Microsoft, brilliant. Keep buying it. Silver, recovering very nicely off of support at 33, and now back up to the 50, and that's almost been a stealth trade. Looking very good. Oil, recovered from the surprise sell-off here. VIX finding support around 21. Walmart, not as good as the other 3 leaders you saw, Kraft, Coke, and McDonald's. However, with the strength in retail, Walmart doing pretty well. Among the XL series, basic industries doing well. Energy recovered from the sell-off in oil. Financials actually back up to their 50. Utilities going sideways, I think, as money is coming out of the defensive sectors, it looks like to me, starting to stabilize and losing some of the growth potential. Discretionary flatlining at 41. And ExxonMobil, not quite as good as Chevron, but still above its 50. So those are the charts of interest. Got a lot of momentum plays that we can carry forward into next week. I'm looking at the U.S., the mid caps and small caps, and certainly the looking at the risk on trade starting to develop. It's Ken Long from Tortoise Capital Management. Keep your powder dry and risk managed.